And all the questions that we had pre-meeting are set, so we can give it a shot.
Fantastic. Well, welcome everybody to the final bull session of January as we wind out what has been a fairly decent January, kind of a month of recovery for many of the stocks in the stock market. And so we kind of look forward to covering some of that. My name is Mark Robertson. I am founder and managing partner of Manifest Investing, and I'm joined here by a very special guest, Kevin Gillogly of the Maryland and Metro DC chapter out in the Washington, DC area. Good afternoon, Kevin.
Good afternoon. And I also have another club, Happy Destiny. So I'm a 2-clubber. I'm not quite up where Ken Kavula is, where he's a 3 and 4 clubber.
Yeah, we can all just aspire. Now, Ken thought about trying to join us, but he is either lost in Punxsutawney or he's on the beach in South Carolina. And that's more likely the case, probably with a book in his hand, perhaps an adult beverage, and somewhere near the ocean. So he's getting a very well-deserved break, and we will take advantage of his absence to needle him and do all kinds of nasty things and volunteer him for other jobs if necessary.
Perfect.
Okay, so we're going to cover a number of things. There's just some stuff down, some theme reminders down at the bottom. It is the year of the rabbit. The second image from the left is just a reminder that the ice fishing around Groundhog Day can be an adventure. The image of Vince Lombardi, that probably brings fear to both of our hearts, Kevin.
Yeah, exactly. I'm so tired of the Packers kicking my Bears.
Yeah, and what the Packers have done to the Lions over the last 2 decades, there should be a law. And
well,
it goes back quite a ways. But Vince Lombardi stands for excellence, and when pride still mattered, I think both of those things still matter when it comes to investing and basically running a decent company in this world. So he's just there just as a reminder. Again, Philadelphia will take on Kansas City in a couple of weeks, and we are by mandate required to cheer on the Philadelphia Eagles as an old NFL team, thanks to the Super Bowl indicator. So sorry, anybody from Kansas City or any Chiefs fans, but the stock market just mandates that we do that. We are coming down to the final days of this year's Groundhog Challenge, and the selections for the next year's contest are rolling in, and I've been processing a bunch of those. The guy there is Mr. Powell. Powell's going to be out with something tomorrow. Interest rate hike. Some people are expecting 25 basis points. We'll see how that goes. And just some quick reminders about data. And I do think we've solved the success of the monkey in this year's Groundhog Challenge, Kevin. And
okay,
that's actually footage from the conference room when our top-notch accounting team assembles to basically audit and finalize the Groundhog results. Clearly, there's a bias there.
What TV commercial was that one from? The Monkees.
That's actually from Career Builder. Every year on the Super Bowl, we get them out. And
yeah, I was going to say that was a Super Bowl ad, so yeah, it ties in perfectly.
Yeah, so we'll be spending some time with that too. That monkey may be back over the next couple of weeks. All right,
exactly.
So let's go ahead and get started.
Oh, I just was looking at the list. George is telling you were talking about Punxsutawney. George says that Ken would not dare go to Punxsutawney without you. So
that'll be his excuse, George. You're absolutely right. No question about it. Someday we'll get there. All right, here's our standard disclaimer. No investment recommendation is intended. You guys all know the drill. This is about education. We're basically demonstrating and illustrating a philosophy, method, or technique, that being the way that the modern investment club movement looks at an opportunity, engages the merit of an opportunity, and acts as a steward, adding the stuff that makes sense to our portfolios and holding them for as long as it makes sense to do so in a true form of portfolio design and management. So you'll hear our opinions, but please do your own homework. If we mention some stocks or mention some tickers, you have to do your own homework, make your own decisions. If we hold something, we may remember to let you know that we have it in our portfolios, but not always. Roundtable, we just did it last week. The next roundtable will be at the end of February, and it is our annual awards celebration, hence the Golden Knights in the lower right. If you'd like to be added to a reminder list, or if you have a friend or family member who you would like to expose to the roundtables, please send an email to nkavula1@comcast.net and specifically request that you be added to that reminder list. If you have any copy or any questions, or if you'd like copies of the slides, those are our 2 email addresses down there at the bottom. Feel free to reach out to us if you need. Okay, so let's go ahead and get underway. Here's our slide of the stock market that we commonly put up. And again, we're basically back at fairly normal conditions. I do think it's kind of interesting that we're back at the blue line with respect to the general stock market indicator as measured by the value line arithmetic average. So we're back to the long-term trend, and that aligns very nicely with the long-term forecast of 11.6 that you see down below. So we're kind of back at that point. No surprise, we're back pretty close to the blue line also. So that 11.6 is what you're seeing displayed on the screen. I still like Ben's comment. And then just wanted to make the point, because we're going to get into it here in a little bit, especially as we talk about Julie's steel dynamics, just this opinion that we definitely were in a period of artificial stimulation back over the last couple of years, and it showed in the stock prices. And that's what Ben thinks too. All right. Here's a quick look at, how has the stock market done over the last month? And I think what you can basically see is that's one of the biggest white bars, this bar on the far right, this right here. That's one of the best months looking back over the last 10 years. It's certainly in the top 3 or 4. And we appear to be having a fairly decent close today, but I have to confess I didn't look at it after about 10:30 this morning. Any comments or questions on that, Kevin?
Nope. I think it says pretty much what we all know.
And, Kevin, you are fairly close to Jerome, at least geographically.
Geographically, that's about it.
Yeah, I just think that maybe you ought to follow him around and make sure that he behaves himself. So,
they're going to do, I like the Peter Lynch approach, which is, you should only be spending about, if you spend an hour talking to economists, you probably wasted 45 minutes to an hour.
That's very true. Or you predicted 7 out of the last 3 recessions.
Exactly.
All right. This is just a quick nod to a theme that we've talked about a little bit, and mysteriously it's going to come back around when we talk about a couple things later. But this is actually the article on the left is a very recent article from the last couple of days. Costco talking about embedding some residential real estate as part of their design. And I find it kind of interesting that we covered that as a topic back in March 2021 of, in this case, some malls being redesigned or reconfigured to include the potential for residential real estate. So I think it's just kind of interesting that theme continues to percolate, and I wouldn't be surprised to see it pick up a little bit of steam. I don't know, is that something out in your area at all, Kevin? Or
well, not that, but I was thinking Gaithersburg, which is just outside DC and the like, they were the first place to have I think a 2 or 3 story Target so that they could build housing in and around it.
Okay.
And they had to modify all their stuff. That was probably done 10 years ago or so. So in other words, it just seems like if you're in metropolitan areas that are growing and you need space, you're going to have to go vertical. And so that makes sense to me.
Yeah, there were a couple places, one near Philadelphia, one somewhere, I believe in Western New York, that we talked about a year and a half ago. It is a very compelling thought, and just something we just wanted to point out that it's still out there.
Mm-hmm.
All right, here's your groundhog update going into the final few days. It's pretty clear that David Einhorn in green light's going to take away the celebrity groundhog thing, but Lisa has reassumed the lead over Kurt, Andrew, Kay's husband, and Herb Lemkool is still on the leaderboard too. They're all still dangerous, but Lisa does seem to be pulling away a little bit. So hat tip to the Great Northwest, and we'll see what happens here over the next couple of days. George Mackey is also just barely off the leaderboard there, or on the leaderboard, almost at the top of it. And Kevin, how's the day going for Montgomery County?
Well, Montgomery County, or MCMC, we were in the lead, I think, on Monday, but now we're in third with, I think, Plymouth nipping on our heels, and it looks like it's Space Coast and Louisiana, Mississippi Model Club to win it. So we may have, even though we're only about 4K behind everyone, it really is moving back and forth. So whatever happens, happens. But to be mentioned in conversation with those two clubs is just good with us.
Absolutely. And in fact, the Space Coast, they're the defending co-champions. So they're back trying to win a number 2. And the other two clubs that I wanted to mention here is the Wichita-based clubs with John Kimmel. I mean, at 22 and 26, he got a former champion there with Plymouth. And they're dangerous, just running out of time. Speaking of,
they're nipping on us. They're nipping on us, so they'll probably surpass us.
Yeah, we all seem to be running out of time, and on that subject, you'll notice down here I have included myself this week, and one of the really neat things about that is I was literally 100 positions lower not that long ago. So 50. I was hoping to make this list by the end so that I could gloat a little bit, but I am a threat to make it. I think I'm only $8,000 off the list. So everybody throw some salt over your shoulder, cross your fingers. But it's kind of nice to be in that position considering where I came from. Because I literally.
Well, Mark, I look at you as a Mendoza line. If you're ahead of Mark, you're doing okay.
I'll take that. I kind of like Del Maxville, but.
Well, okay, we'll make it a Del Maxville line. For those that don't know, Mendoza and Maxwell were good fielding infielders that couldn't hit their weight.
And I certainly couldn't do that anymore. Anyhow, these two statistics are as good as they've been during the entire contest. The average relative return is better than it's been. And that 25%, although it's near an all-time low for the Groundhog Challenge, it's higher than it's been this year, so we'll take it. And Kathy still is 163rd of 164, so we'll just press on here. Here's a reminder about what the contest is about, and not going to read the slide to you, but I think all of this applies to not just the Groundhog Challenge. One of the things that we have witnessed over the years, not just with our Groundhog Challenge, but some of the chapter contests that we're familiar with, is there's not a whole lot of swing for the fences, short-term thinking in these things. And we do actually pay a lot more attention to the collective results. And in some cases, some of us have been at this for the Groundhog for 16 years. So you have basically a pile of 16 years of results. And we kind of care what that collective result looks like. More on that during next week's session. And it'll certainly finalize on Thursday. So we have had a lot of fun. Again, David Einhorn is going to win for the second time, but he's either very hot or very cold over the contest, and just kind of keep it fun. Here was the final selections made this weekend by the Barons Roundtable. We kind of keep our finger on their pulse also. We shared Abby Cohen's selections last weekend, and some of these are a little bit compelling. There's been a few people submitting entries for the next year's Groundhog, selecting Ball Corporation, which is a bit of a surprise. But I think I can see what some of our community of investors see in that one. But not a whole lot here to get overly excited about. Anything jump off the page here, Kevin?
No, I look at this list and I sort of look at, they're trying to see what's going to do well in the next year. And in that sense, I think it's very similar to, say, like our undervalued feature, which is looking out 18 months. And so therefore, I probably would think that they'd have some RSIs that were pretty beaten down. And they really aren't.
Yeah.
I'd expect to see some 40s and 30s, some low 40s, 30s, maybe even some 20s. So that's the one thing that sort of stands out to me. But yeah, we'll have to see how they do over the next year.
Yeah, I do think if I were called and asked to serve on the Barron's table, Kevin's absolutely right. I would definitely be shopping for some low RSIs when it comes to this. And over here, we've circled the 1 year total return forecast according to the analyst consensus estimates. And I find it kind of fascinating that these are not very robust. And Ken has asked the question several times, so I thought in his absence today we'd go ahead and answer it. And he'll yell at me for dealing with this while he was gone. But here, what we have done, and I know this is a lot of ugliness here, but what we basically did is began the answer to the question, going back and looking at the analyst consensus estimates for the next year, all the way back at the end of 2021, and what actually happened during 2022. The overall answer to the question is the analysts were expecting 20.6 that you can see here. What actually happened with these approximately 1,500 companies, again, sticking to the companies in the Value Line Standard Edition, came in at minus 15. So that's a bit of a miss, hence the puzzled rhino on the graph. So what you see here is those 1,500 companies. The x-axis is basically showing you what the return forecast was. So the company with the highest return forecast a year ago was, fascinatingly enough, and this, Kevin, this is like amazing. That's Greenlight Capital.
Okay.
And
you wouldn't expect a capital company to do well in this last year.
Yeah, I mean, check that out. I mean, and the actual result is actually fairly low. It's barely positive, but it's a whole lot better than all of this.
Absolutely.
Okay. So the actual forecasts, the forecasts are actually on the x-axis. The actual returns are on the Y. So you can see that there's a whole lot of companies. Here's your red line, Kevin. This is 0. Okay, so there's a whole lot of blue dots below, and hence the minus 15.3. So what this is basically showing is forecasting, especially over 1 year, is, and I have to use a PG-13 word, rough. And I threw some names at these to just kind of give a little bit of a feel. The best performing company, and who would have expected this one? That's a mortgage company up at the top. That's Annaly Mortgage. It's a mortgage REIT. Now here's Warren Buffett's contribution to the year. That's Occidental Petroleum, but Helmerich and Payne, and then a whole bunch of oil and gas related stocks up here in this quadrant. Worst performers, I didn't even have the courage to look at some of these, see what they actually are. I probably own some of those. But here's Carvana, which has been in the press quite a bit here lately. And the worst forecast for the year was this IDT out here. So again, I don't know. I want to see the results of more years to see what this looks like, year by year. But that's reducing the amount of emphasis that I would put on that characteristic as I'm charting it for companies that I'm considering. So does that help at all, Kevin, or is that just completely confusing?
No, I think it is, and I think it's one of the things we tend to do is we really hover very close to the analyst consensus estimate, whether it's on our SSG or on our projections, and we sort of hover really close to it. And it's just like, I mean, look at this. We had a 20.6 was our forecast, and it ended up being a minus 15.3. To stick with that baseball reference, I'm going to go to Bull Durham and say just a bit outside. That's 35, 36% off on the difference. So, they're just guessing. And, I like what Hugh McManus has said over the years is that the more and more I do this, more and more I think I can do just as well as those analysts can.
Yeah, and not to pick on the analysts, I just think, they spend an awful lot of time focusing on quarter forecasts and 1 year forecasts. And what is fascinating is, take a longer term perspective, it actually gets easier and more accurate for 5-year forecasts. It's just just amazing what this community does. All right, enough on that. Here's a quick look at some of the early entries submitted. Again, it's a busy slide. I just want to point out that there is a distribution of number of companies selected. About the average comes in at about 8. people send in 8. Some people going for the gusto submit as few as 5, but most people are coming in that 8 to 10 range. Here's the most frequently selected companies so far, and they're coming in every 10 minutes. I seem like I get a couple more entries, but some recent Ken Kavula favorites are definitely, in fact, all of these with the exception of Amazon are Ken Kavula favorites from recent presentations, either at Ticker Talk or roundtables, that sort of thing. And he talks about these companies quite a bit. So it's a lot to put on the shoulders of the big guy, but he's got to have a good year here for the Groundhog to have a good year. So a lot of pressure on him. But any surprises on there, Kevin, or companies that kind of grab your attention?
No, I think in my 2 clubs, what's kind of nice is I see several stocks that we own or we're going to be looking at in the coming weeks. So that feels pretty good. So yeah, it means I'm fishing in the right part of the pond, and that's the way I sort of look at it.
Yeah, the community is definitely onto some of these. We did present Lululemon, or I did during the most recent roundtable. None of you voted for it, but somebody wrote to me and said that apparently the Investor Advisory Service also featured it fairly recently. Do I have that right?
I think that's right.
Okay.
I think it did come on in on that one.
Okay. And then, of course, I have expressed an admiration for Trex and Yeti, and they're down here at the bottom of the list, of course. All right.
Yeah, but I know that Ken was pushing Yeti, so you can give that one to Ken.
Oh, so he gets joint credit on that one. Again,
yeah, exactly.
Again, just the rules of engagement: submit a minimum of 5 investments and a maximum of 20 on the start of the next year, which is February 3rd. You receive $1 million in Groundhog dollars and spread evenly depending on how many you've submitted. We do individuals and clubs, as you've seen, and you can send them either by email or posting them in the challenge folder for those that want to share their selections. No penny stocks, so we require a minimum price of $1. And keep in mind that dividends are accounted for, so in the contest. All right. Ready to switch gears, Kevin?
Absolutely.
All right. And Julie, feel free to chime in. This is a question from Julie, just wondering about Steel Dynamics, ticker STLD. And she basically pointed out an area of confusion. Our projected annual return seemed a little bit robust, along with our earnings compared to Value Line. And she comments that it just seemed like the stuff that she was seeing on SSG Plus output from Better Investing was inconsistent with what Manifest was saying, and we'll take a closer look at that. And, what is the problem? Now, one of the things I will point out is with companies here, especially here over the last few days, and especially at this time of year, as the analysts actually start checking in with their next year forecasts. So you do get a little bit of turbulence. Think of it as a disturbance in the force. So you can actually get some fairly interesting stuff going on. I would almost call it convulsions at some point when it comes to their analysis. So you can get a little bit of turbulence there. Another thing that I did share with Julie was that a lot of times when I get a question like this, you want to make sure that you're not looking at as reported versus conditioned data. That's not the case here, but a lot of times that will explain a significant difference between the two sources. But basically I said, well, let's just take a look and see what's going on here. The first thing that I would point out when dealing with any company like this, and by the way, I own this one with real dollars, and it's also part of my Groundhog portfolio. So Julie and I have both of us have STLD in our Groundhog portfolios for the current contest. More on that in a minute. But when you're dealing with a company like this, and I think it's a very fascinating study, interesting company to take a look at. In fact, here's a product improvement suggestion for Value Line, Kevin. I took the box on the lower right of a company report page, and I put it up at the top.
I see that.
Financial strength here, they really ought to do this. And the point that I want to make is anytime you're dealing with an earnings predictability in the 30, 25, 20 or lower area. And if you're relatively new to investing, it basically means that it becomes much more challenging to do an analysis on the company, less predictable. How's that for intuitive, Kevin? It's just a bigger challenge, so be aware of that. You can run into instances like we're about to describe. Are you familiar with this company, Kevin? Is this one you've looked at all?
No, we haven't. I'm curious because again, I look at this and I see some of the things I would look at is if you look at the relative PE ratio up at the top, 0.38, and then you look at where they're projecting the relative PE ratio in the projections of 25 to 27, where it goes to 0.7. That's a nice PE expansion. You're seeing it also with the value line versus the price there on the in the graph. So those two things just sort of give me a pretty good. I'm like, intrigued, but you know, the financial strength is sort of weak and the predictability is off, but it's clearly worth a look. Let me put it to you that way.
Yeah, so it's a little bit of foreshadowing. Julie and I both picked this company for the groundhog right here. That little lower end of that candle right there, and it's up here, so you can guess what contribution this has made in a year where the average stock is down about 20%. So good, clean fun. So again, company with a little bit of an issue. A little bit more challenging. It's a great company. It's a growth cyclical, and once you get your hands around these as an investor, they can be extremely rewarding. Gentex comes to mind here in the Michigan area. So what you're looking at here is the stock selection guide display from Better Investing. And as Julie had said in her notes, she superimposed the analyst estimates. She's talking about these. And yeah, they do drop off. So it's natural cyclicality, even with the infrastructure stuff that's going on, embedded as part of it. So those are actually added there just for reference. And you can see it makes it a pretty tough call to make a prediction. On the right now, these numbers are exactly the same, Julie. That's one of the points I wanted to make, is that when you're looking at the manifest investing display for this company on the far right here, those are literally the same. So the numbers that you see here, they could be off slightly. They might be looking at a slightly different group of analysts, but those are basically the same. The bigger difference that we do when we take a look at any company, not just one of these that's a little more challenging, is we basically embed those forward-looking estimates in the formation of that red dotted trend. And we just think that's prudent to do, especially when you get into a situation where you have some downs and some ups, some cycles in the graphic. So they're basically informational on the stock selection guide on the left, but for us, they are embedded in that trend mathematically. Same thing for earnings. You can see that it looks a little bit less exaggerated on ours, but those are actually the same points. And again, it's reflecting a return to, what I would argue is probably a more average trajectory in the future. Now, some of that may have some recession type thinking or expectation. So that's where we get into a little bit of a tussle. Now, where the rub comes in with this type of analysis, as you go through the math, is the fact that the sales actual numbers drifted up quite a distance from the trend. So we basically cheat with most companies. With most companies, the red dotted line stays pretty close to the actual sales, actual results, and estimates, and they kind of track on top of each other. In this case, the drift has become quite significant, and the use of a trailing 12 months number is going to introduce quite an error into the situation. That's what we ran into. So we got caught being a little bit lazy, so thank you, Julie, for bringing this one to our attention. Probably going to go back and see if I need to correct for that. We did a whole bunch of this back during the depths of the recession, as many companies were impacted this way in the other direction. But now the bubble to the upside is what we're dealing with. Here's a closer look at what I'm talking about. So when we forecast the future sales using the trailing 12 months from this point shown on the graphic, I'm having trouble seeing my cursor here today. Might have to look at how to upsize that. Basically, projecting from there, you're going to get quite an over embellishment of the situation. So if you go back to the trend line here, this is where we are today, kind of looking at a map. You are here, and just kind of eyeballing it, we're basically talking about being at levels like we were back in 2018. That would be a much better number to use or mathematically figure out, which is probably what I'll end up doing for a number of these companies, making sure that we're calculating from here and not from up here.
Mm-hmm.
The result of that is a little bit different situation. You can see the bubbles on the graphic. I think that the operating margins, the bottom line net margins, and hence the PE ratios were impacted pretty significantly by what happened post-COVID and with the infrastructure and some of the stuff that's going on. They've gotten a pretty good burst of orders, and probably not something that will continue going forward. So you can see the disruption there. Interestingly enough, you take a look at value line, you can see that the value line total return forecast is actually negative. And here's one of the great mysteries of life. And Kevin, here again, this is what makes a market. You look at those analysts, and they're basically saying this company is dramatically underpriced, even with the current situation. So, wow, that's as big of a divergence as I think I've seen in a while.
You know what I've noticed in looking at value line since probably about a year into the pandemic was, that value line now has its 18-month price target as well as their 3 to 5 year.
Mm-hmm.
And I've seen a lot of the 18-month ones to have a higher return than the 3 to 5 year. The absolute price as well as the rate of return. And it's just like, I think that's where they just think something's sort of getting away from themselves. So I hadn't seen that before, but the 18-month mark is something that I think Value Line's only had for like 2.5 years now.
Yeah, and that's kind of a function of Value Line having to serve a wide audience, all the way from pattern traders, day traders, to shorter term, I would call them long-term traders, short-term investors that are looking at 12 to 18-month time frames.
That's a good description. That's a good description.
I just think it's a massive challenge to do that well, and with any type of quote unquote accuracy. So good.
So should we bring in Julie and have her come through with some of this?
Yeah,
since she's the one who brought it to us.
Because here is the
Julie?
bottom line after making the adjustments and basically going back and no longer using the trailing 12 months for this number, and that's where the real problem came in, Julie. And again, thank you very much for bringing it to the attention. It just means that I need to dig in and figure out where those divergences are happening and make sure we don't have a similar situation. But it's still a solid-looking company over the long term. I do find it kind of fascinating that the return forecast has had its own cycling adventure that you see here. Any comments or questions at this point, Julie? Does that help you with what you were curious about?
Yeah, I think it helps. It was just so confusing when I was trying to do the SSG, and based on that whole Build Back America Biden thing, I just feel like this company is going to do well, but trying to do the SSG, it was like, something's weird here.
Yeah, I do.
So what does this company actually do?
Well, they basically make a bunch of finished steel products for a variety of different industries, construction, infrastructure type industries. So
and they also recycle.
And a lot of recycling too. Yeah, they're definitely well managed, well put together. And Julie, I do think that without that, the bills that have been passed by Congress, that these numbers over here probably would be looking lower, because the analysts would probably really be expecting a recessionary dip in their overall business. But time will tell when it comes to that kind of stuff. So this
Yeah.
this basically brings the company back into what I would look at as kind of a normal hold. I certainly wouldn't be panicking over it. I actually do own it. So if it does take off and continue to increase in price, basically beating expectations, I might be tempted to take a little bit off the table. But this is probably a lot less mysterious than what you were faced with originally, I would think.
Yeah. Well, they're reporting late February, it said, so I'm going to watch for that.
Mm-hmm. And of course, here's the situation we're in. That's Julie and I were both pleased with that bump in stock price during a down market. So unfortunately, it wasn't enough to put me up at the top, but I think you're 16th in the Groundhog?
Yeah.
Yeah.
Shockingly.
So right up there, beating the market. And one of the other things that this kind of prompted me to do, I just made a wish, kind of off the cuff wish to Kurt in a discussion the other night. And I woke up the next morning and here's what he had done. I said, if as a holder of Steel Dynamics, I'd certainly want to know if the price actually catches fire and shoots up to a relative strength above 80. So you can now go on to your Steel Dynamics company report page, click on that alert section to either edit an existing alert or the down arrow to enter a condition. And what I've set up is I want to receive an email if that RSI goes above 80. Now, that doesn't mean I'm going to automatically sell it, but I'm certainly going to take a look at it. Because if the stock price shoots up, let's say it goes up to 140 day after tomorrow, the projected annual return would drop down close to zero, as shown here. Okay, so this projected annual return would drop down close to zero, and the relative strength index would be up somewhere around 80. So that is an opportunity to decide if I want to continue ownership or perhaps sell a partial position in the company. So it's going to be interesting. This is probably something that I have wished for a long time. All it took was me wishing over the phone, and he makes miracles happen. So I would encourage everybody to check that out. All right.
I really like it. That's really cool.
And of course, all those other settings, I think what we'll probably do here, especially after he gets done with a few more of his tweaks, is come back to this and actually go through a series of demonstrations on setting up very logical alerts on a managed portfolio. So good, clean fun. Good to hear. All right.
Like
Thanks,
it.
Julie. And enjoy the weather down in Cancun.
Every hour.
So it sounds like a pretty good position to be in. All right, Kevin. We've been talking a lot about management of companies and recognizing good management, and this article actually popped up in the Wall Street Journal this weekend, so I thought we would spend just a few moments talking about a community favorite, Bed Bath & Beyond. Are you a shareholder? Is this a company you've tracked over the years? Do I still have you, Kevin? You're muted.
Yeah. No, I have. I'm sort of tethering, and I think the wind sort of knocked me out for a while.
Really? Okay.
Yeah. I don't know. It happens sometimes.
All right. So anyhow, you don't know as a mathematician how much I was tempted to put the Eisenberg principle on the slide. So the Eisenberg and Feinstein connection there for Bed Bath & Beyond. This company has been in our community for quite some time. In fact, it was the subject of many up, straight, and parallel presentations for several years. And I went back and checked. I actually have a Better Investing magazine sitting right next to me from 2003. And I'm not sure how high it got up on the list. Somebody out there probably remembers. But it definitely got up into the 22nd position. I'm pretty sure it was even slightly higher than that for a while. And like we say, it was the poster child for up, straight, and parallel. The thing we want to spend a few moments talking about is Leonard and Warren actually left their executive positions in 2003. They continued on the board until, what did we say earlier, Kevin? It's in the Wall Street Journal article.
2019.
So in 19. So they were an influence from 2003 to 2019. They were not directly responsible for the operations, but it's kind of fascinating to watch, what can happen to companies like this over time. Another shot of the two gentlemen there. And one of the reasons we were talking about this is I had brought up the notion of, when you find a company that seems to be very well managed, sometimes it can come down to a leader. And let me disclaim that a little bit. I think for every leader, it really does matter, the workers of the company and the culture and all that. I don't think you're going to argue with that, Kevin. But
No.
We do kind of use Larry Bossidy as an example. And the reason I do that is this is somebody that Tom O'Hara used to use as an example of an individual that had made him a successful investor. And again, as a member of the Mutual Club of Detroit, he would talk about Bossidy. And Bossidy has a General Electric background, Allied Signal, and ultimately Honeywell. And we basically covered this in the article down here. You can actually go look at it. It was from a club visit by Tom O'Hara to our club in Chicago, that's where these words are taken from. But literally, Mr. O'Hara invested in Allied Signal and then took his money out and wherever Bossidy went and followed him. And as you can see written there, success at all three situations. So when somebody seems to have an idea how to do this stuff, you kind of want to let them run. All right.
Yeah.
So again,
I was going to say that.
Go ahead, Kevin.
I was going to say, when we were talking about this before, is I was trying to find the citation, and maybe someone in our audience can do it, is that I was reading, I think, one of the old manuals, and it said that George Nicholson on his SSG would put a mark or a star whenever the new management came in. So wherever they were, and I've started to do that a few times on some of my presentations, just to remind myself when the new management team came in and how many of those numbers are really theirs. So
yeah, I actually have seen examples of him making those marks, and I think it cuts both ways. I mean, the reference there to Phil Keating, he used to keep two lists of companies. One was a list of companies that if the company plane went down, he would be interested in buying. And the other one was if the company plane went down, he'd be interested in selling. So you can read into that what you will. It's a little bit dark, but again, the strength of a good leadership and management team can be quite impressive. And then I think you're the one that came up with Peter Lynch's advice on this subject.
yeah, now one of my all-time favorite books is One Up on Wall Street, and he says, buy a company in which any idiot can run because sooner or later they will.
And again, that's a little bit harsh, but it's unfortunately quite true.
If you look at Bed Bath and Beyond, and you see some of the stuff in terms of the change of management and where they went, yeah, they didn't keep up.
So here's just a little bit of a sprinkling of stuff over time. On the left, you basically see a very busy stock selection guide showing some of that up, straight, and parallel, but a little bit of the breakdown and a little bit of the decline in profitability that you see here on the lower right. Again, keep in mind that the original stock selection guides plotted sales and this graphic right here on the front side of the stock selection guide. Didn't even bother to plot earnings. So I used to inject that section 2A pre-tax profit margin trend onto many of my guides. And I actually grabbed this one from over 10 years ago. And you were beginning to see some of the signs of perhaps a little bit of weakening. This would have been a couple of years after those guys did their first step down from the company. And you see that up here, and a little bit of a bounce. And then, of course, the wheels really fall off around here. So, again, two major points, right there, as Kevin was saying. And then over here, one more. And I think you can basically look at this and superimpose some of the work that we've done with life cycle. And Kevin, I know you spend a lot of time on this stuff too.
Yeah. No, I was reading a bio on T. Rowe Price and got the supplementary book on this picking growth stocks. And as I'm reading this it's the book here is basically a collection of what he wrote for Barron's in 1939. And all of a sudden I see this line about the life cycle, and it's like, wait a minute, that's what we've had in Toolkit and in Take Stock and now in the SSG manual, the digital handbook. And I really like using this because, and we do it in a webinar that we do here in the DC and Maryland chapters. We sort of ask our presenters, where does your company fit on this life cycle? Because I think once you're done doing all the judgment points, you sometimes sort of forget that, yeah, you're dealing with a company, and where do you think it is and where do you think it's going? And I think it sort of helps crystallize people's thoughts on those things.
Yeah, I do think it's important to be able to kind of peg where you think the company is as you're building expectations. Back about 18 months ago, many of you in the audience will remember we spent an awful lot of time talking about getting into this zone a little bit. In fact, we talked about Amazon and other companies, but the example we're talking about today, we're actually looking out here somewhere. And other end of the spectrum, both equally important as an investor. And I was kind of reminded of this. I went back and looked. I've actually got a plaque on my wall that has the Better Investing Top 100 from 1999. And Pfizer, GE, Tricon Global, Lucent Technologies, these are companies at the top. And some of those kind of fell into this area ultimately. So you want to be careful with that. So,
and I was going to say the other thing is that I think, a lot of us, we always want to get those explosive growth. Those are great. You're going to find that usually you have to pay pretty dearly for them. And I tell you, I've found some really nice ones in that mature growth. They're just beaten down, and they have those, as we talked about with the value line, where the projected relative value from where the current relative value shows you that, or a coiled spring, and you're like, I have an opportunity to make money on it. And that's the whole point of doing this.
Yeah, absolutely. All right, so here's a look at the Bed Bath & Beyond fairly current value line report. Just a couple of things that really kind of jump off the page at me. Again, that decline that starts a little over 5 years ago or more, in price back in here, just noticing a couple of things. The first thing, when you're talking about this chart, for any retailer, you absolutely have to have a handle on this line right here, at least with respect to what it means to the business model. And you see that they basically peaked in number of stores. If you want more on this subject, go back and look at the articles that were published in Better Investing magazine on Toys R Us and what happened when they hit that brick wall. And same situation here. Notice that the number of stores, they're basically closing stores left and right over the last few years. So it's a real danger Will Robinson signal for a retailer like this. A couple other things I noticed, and Kevin, feel free to jump in where you want. They basically started taking on debt in the middle of the last decade that you see down here. Fairly significant amounts of debt relative to never having debt in their entire operating history. And this is going to come off more negative than it should. But what I basically see that debt going to is buying back stock, buying back shares, and issuing a dividend. Now, dividends are good, don't get me wrong, but there are times when dividends can be a problem. The existence of dividends, the way you want to think about dividends, companies basically begin paying dividends when their growth either slows or stops or matures. And in some cases, it can actually be quite a dangerous signal, especially when you can't maintain those dividends. And you see that in the case of Bed Bath & Beyond. So, this is a situation. This did not happen overnight. This thing fell apart over quite an extended time frame. And I think a lot of the danger signals are here. So again, the implementation of a dividend, again, I almost think it as attempting to bribe or return cash capital to shareholders as the situation weakened. And it's a pretty nasty situation overall. And the other thing that kind of jumps at me, Kevin, is look how much time has elapsed since these things actually began happening. I mean, people are making it sound like this all has happened in the last year or so. Operationally, the degradation started a long time ago. Your thoughts?
Yeah. No, I also look, you look at the dividend, and then I always go down to all dividends to net profit, the last line down there, basically a payout ratio. And it's just like, okay, yeah, you're paying stuff out, but then all of a sudden you have all these non-meaningful numbers from 2018 going forward. Heck, even if you sold this at the bottom of the 2018 market, that's $10.05. You're still 10 times better than where you are right now. So, it tells you that we do, even though we would have missed a lot of stuff there, you still would have been a lot better off than where you are now, hoping for it to come back.
And now you're going to be reading stuff that, and it could be the case that this is now a turnaround story. Probably have to draw another line in here somewhere, Kevin. Where do you start? You're basically trying to start over from somewhere in here, and they're starting over with hopefully their most profitable and the stores that are most likely to lead to success for the company. But you can see that they've pared down to half or a third of what they were, and it's just a fascinating story. And again, this is going to sound more harsh than it probably should, but this company is completely a debt instrument now. Basically, the value of the shares is under 10% of the total value of the company. So if you, quote unquote, invest in this company, you're basically issuing forgivable debt. And forgivable debt as a shareholder is pretty rough.
Yeah, and the story that we have up there, Mark, that with the two sort of founders, is they even admitted the one thing that they missed was that they didn't factor in the internet, e-commerce. They thought people, excuse me, still wanted to go to stores, and that whole change in dynamic, regardless of the pandemic. As I heard one person say, what happened with the pandemic just changed things and accelerated what was going to happen over the next 10 years. And I think that's, they didn't adjust to the changes in what's going on. Same thing happened to linens and things.
Yeah, linens and things, Pier 1. Pier 1 had the same type of situation. And again, I think it's a reincarnation in a different level of Netflix versus Blockbuster.
Let's stop here. I have a couple questions and I haven't gotten to it.
Okay.
One, Barbara here is asking, how specifically can we determine where a company is in its life cycle? For example, like Apple.
Well, I'll let you give your answer also, but I mean, I think you can see different areas of growth. And again, without throwing any numbers at it, this is definitely a different slope right here than right here. And then obviously there's a moment this really flattens out. And of course, the downward slide is definitely in the 2019 timeframe. They're definitely at that point of decision that they need to either reinvent themselves or they're going to have serious trouble in company after company. And your thoughts on this, Kevin?
No, I mean, you're visually doing exactly what we do in the visual analysis as well, is that, you can sit there and take out the older years and see how the trend has been for the last 2 years. You can do it when you're in the preferred procedure. You can see how the sales growth and earnings trend is when you have that pull-out window. Those things do it. But I think the larger thing is that where you think it is in the life cycle is sort of like, how much sugar you like with your coffee. And you may say, well, I don't like any sugar. And, I think it's sort of a preference. But to me, a large company like Apple, if they're still growing at the rate of what we would consider in BI a small company, it's still got a huge growth story. I don't think that that's anywhere near done yet. Now, I don't own Apple, so I'll defer to the Apple owners here. But that's, I think it becomes sort of a subjective thing, probably even more subjective to me than even your judgments on the SSG. It's just sort of like, where do you feel it is? That's
Yeah,
all.
it's important to at least ballpark it to understand the elements of that. And of course, on the front end of the earnings, that's easy. Where did they break out and actually have earnings? That's this point back here. That's fairly easy to identify for most companies. Basically when the earnings turn positive, but when they decline and go negative, you're basically out in here and into survival land, and where survival is a question mark. And these numbers, of course, are massive. It really messes up this graph. The fact that this is way down here. Now, as an engineer, I don't like it when my graphs get messed up. And Dow Maxville wouldn't like it either. Okay, any other questions or comments on this, Kevin?
No, that's it.
And not to beat up on Bed Bath & Beyond, but our community is notorious for having a distrust of retail and retailers. And I really think that having a handle on that number of stores, in fact, I wouldn't be disappointed if number of stores didn't automatically pop up on stock selection guides at Better Investing as part of the trend to watch very carefully.
And we were talking about this before we opened things up. I presented Boot Barn for the roundtable, I think back in November. And there it is. It's a retail company, but what they've done is, and we talked about this, is that they've developed a loyalty program. Alta does that as well. They have a really, those are the people that are coming in. But the philosophy with Boot Barn is that you're going to want to come on in and get a custom fit. So you can't do that necessarily over the phone or over the internet. And therefore, once they come into the store, they're more likely to buy things. And so they were able to figure out a way to integrate, being a brick and mortar with an online feator. I mean, heck, Home Depot has done that. I remember when I was teaching off of the Home Depot and Lowe's for our SSG class here, probably about 6-7 years ago. At that time, I think Home Depot was the second largest online retailer after Amazon in the U.S. I don't think that's the case anymore. But the fact is that Home Depot was able to adjust. And you see how many of these restaurateurs are able to adjust because of the pandemic. So, it's learning how to be nimble enough to adjust. And like we were saying, retail, you've got to be extremely nimble on taste, preferences, and shopping and buying patterns.
Yeah, and there is kind of a poignant moment. And I have to tell you, Kevin, I don't spend a lot of time in Bed Bath & Beyond. That probably surprises you. But
I'm shocked.
During a recent visit, and I'm going to take credit for this, I picked up a package of kitchen towels. And I actually had the same reaction that's documented in the Wall Street Journal article. It's like, why in the world would I want to buy 8 of these? And these two guys are basically reminiscing and talking about a recent Bed Bath & Beyond store visit, and they recount that same thing. You talk about just the basics of understanding business. And I'm just glad I'm not responsible for product management at Bed Bath & Beyond and reading that in the pages of the Wall Street Journal. So yeah, I had that same reaction. All right, here's a reminder that we archive all of these sessions, including the roundtables, the monthly roundtables, on the Manifest Investing YouTube page. Please feel free to share this with friends and family and encourage them to subscribe so we can let all of you know when new content is added. We are looking at mid-March, most likely March 14th. A lot depends on Matt, because we'd like Matt Spielman to join us for this session. And he's already compiling thoughts to share with respect to the global subject that's being dealt with by these two books in tandem. So we at least have penciled in March 14th at this point. That's about 6 weeks out if you want to do your own homework and prepare for that. Again, a reminder that the end of February, 4 weeks from now, is our February roundtable with the awards program. So that's going to be fun. And that quote still stands. We've had a massively good year thanks to a couple of very fortunate speculations in the roundtable tracking portfolio. So tune in to learn more about that. Here's our just quick nod to the best small companies. They continue to gain favor from us. And I just wanted a moment to cite the power of the raconteur, Ken Cavola, because those of you who were with us last week, you can actually go back and check it. It's documented. It's recorded. He basically said he looks forward to the difference between the left-hand chart and the right-hand chart. Do you see it, Kevin?
Yeah.
Scale change. He actually said the words that he looked forward to the scale change. So yes, the raconteur moves markets. And there's proof. All right, Kevin, I'll let you do a plug for your shameless grifting for your adventures with Better Investing Magazine. Go ahead, sir.
Thank you. I've noticed some of you have come on over, but the DC chapter and the Maryland chapter have been looking at the getting stock ideas on the BI magazine and website for about 2.25 years. We look always at the stock to study and the undervalued feature, and we have then we have two others that usually come from either the magazine or really the website. First Monday of the month, free. It starts at 7 o'clock Eastern, and we do have a YouTube channel, and we'll talk about that. So we are going to be it's this Monday, so the 6th. So it's going to be Icon, and I forget what the undervalued feature is, and a couple others that are drawing a blank. And here's our YouTube channel. You can either find us by doing youtube.com/@digging into BI, or just type in digging into BI in the search window of any YouTube. Things are organized by chapters, and chapters are basically the way they segment videos. So you can just go straight to whatever stock presentation you want to listen to. It's about like the roundtable, about an hour and a half worth of it. And we allow you to vote and sort of figure out which one you like. So I see a couple of our presenters are actually in the audience tonight. So thanks a lot. So we've gotten a real, we've had like 26 different people, not just directors, but people either in the model clubs or just people that want to help out from either Maryland, DC, or Virginia to help out. So it's been a very good collaboration with a adjoining chapter.
Some formidable investors out there.
And so there's the people from the Maryland and DC chapter at BINC that were there. You can sign up for the mailing list if you're not on it by going to the DC chapter, or you can just send a email to the diggingintobI@gmail, and we will get you set up. But come and join us. Again, it's just our opinion. You can do your own research, but we do it a little bit more in depth than like you'd see on the ticker talk, because again, we give them about 10 to 13 minutes to sort of complete their presentation, so you can get pretty detailed. But yeah, I'm glad to have people.
All right, some really good investors on that slide that I've had the privilege of spending some wonderful moments with over the years, and it's just fascinating to see what people can do as they get together and share their ideas and thoughts and explore opportunity. It's a good, clean fun. And
I was going to say on that one, Mark, is that one of our directors said it early on, is that what they really enjoyed was seeing all the different ways that people put together an SSG. To newcomers, they think it's a straitjacket, the stock selection guide to make it in. To make your judgments, and it really isn't. There's really a wide range of ways to interpret what those numbers say.
Yeah, that reminds me, I want to get out my presentation on the stock selection guide that I recently did in an interview here in the last couple of weeks, and share that with everybody. Well, that is kind of the state of Detroit, the Detroit area. That could be Len Douglas's house, probably just a little bit north of where he lives, and it's a beautiful area, but pretty cold these days. So with that, I think we'll go ahead and sign off. Any other questions or things we need to?
Well, I was a little lax on some of the questions. Some of them were dealing with your logical alerts and stuff like that. If we go to the new alerts page that you were talking about.
Okay, I'll tell you what. I'll sign off and I'll just shut down the recording. But then I'll take advantage of just going live on the website and show everybody what that looks like. If that
perfect.
Sounds like.
I think that may be able to